The rise of the Northern Trust Houses. It began with a quiet confidence, the kind that settles over a region when its institutions finally discover a formula that seems to work. In the northern kingdoms, far from the noise of Europe's great capitals, a new kind of financial power emerged, discreet, disciplined, and rooted in a culture that prized stability above spectacle. These were not banks built on grandeur. They were houses of trust, shaped by tradition, guarded by caution, and strengthened by a reputation that seemed almost unbreakable. To understand how these northern trust houses rose from modest origins to become arbiters of regional influence, we must return to an era when the North was reinventing itself. Trade routes expanded. Merchant fleets grew. Local industries transformed small towns into thriving ports. Yet beneath the prosperity ran a persistent challenge: how to manage wealth in a landscape shaped by harsh winters, unpredictable markets, and communities that had learned over centuries to value restraint over risk. The story begins in a coastal city where traders gathered not for ambition but for survival. Harsh seasons taught them to prepare for uncertainty, and from that mindset emerged institutions designed with unusual discipline. The first trust houses offered simple services: safekeeping, settlements, modest loans backed by tangible assets. But what set them apart was not their function, it was their philosophy. They valued prudence over profit, clarity over complexity, reputation over expansion. Clients entrusted them with fledgling fortunes because they believed these houses would protect, not gamble, their hard-earned gains. As trade blossomed along northern waters, the trust houses grew with it. They became pillars of their communities, known for conservative policies that ensured steady returns even when wider markets faltered. Generations of merchants came to see them as guardians of stability. Governments quietly relied on them during moments of fiscal strain. And foreign investors, weary of volatility elsewhere, sought refuge in their measured approach. Strength built slowly, quietly, almost imperceptibly. But beneath this rising success lay a subtle shift, one few noticed at first. As the trust houses expanded their services, they began taking on new responsibilities that stretched the limits of their traditional mandate. Larger loans, complex settlements, partnerships with foreign enterprises. Their ledgers grew thicker, their networks wider. And in the silence of their well-ordered offices, early hints of imbalance flickered like distant lanterns along a dark shoreline. For now, the system held. Confidence remained high. But those closest to the ledgers sensed what history so often reveals, that even the most disciplined institutions face pressure when growth begins to challenge identity. And in the North, a tension had begun to take shape, one that would test whether trust alone could anchor a financial world evolving faster than its guardians anticipated. The expansion of the northern trust houses accelerated as new opportunities swept across the region. Industries modernized. Shipping companies demanded larger credit lines. Foreign partners proposed ambitious ventures that promised profits unheard of in earlier generations. The trust houses, long accustomed to conservative operations, now found themselves standing at the threshold of growth that seemed both inevitable and irresistible. Inside their polished wooden offices, debate simmered beneath the calm exterior. Senior stewards, custodians of century-old traditions, urged caution. They warned that rapid expansion required vigilance, that every new service introduced a layer of complexity the trust houses had never been forced to confront. But younger advisors, energized by the region's momentum, insisted that the future belonged to those willing to adapt. The North was changing. Why should its financial institutions remain anchored to the past? The shift began subtly. A trust house that once refused to lend without substantial collateral introduced more flexible terms. Another began financing ventures tied to foreign markets it understood only partially. Settlement services expanded. Contracts grew thicker. Ledgers recorded transactions that reflected not only prudence, but ambition. Nothing seemed reckless, not yet, but each decision nudged the houses further from the foundations that had once made them unshakable. Merchants noticed the transformation before the public did. They observed that the trust houses processed settlements more quickly, approved loans more generously, and engaged with distant partners more frequently. Some applauded the evolution. Others felt uneasy, sensing that the institutions once anchored in restraint were now navigating unfamiliar waters. Yet profits rose, accounts grew, and northern prosperity deepened. Concern remained quiet. But pressure came from beyond the region as well. Foreign investors, impressed by the steadiness of northern finance, poured capital into the trust houses. Their expectations, however, differed from those of longtime local clients. They demanded higher yields, faster returns, and broader portfolios. Their influence slipped into policy meetings, shaping decisions in ways that favored growth over stability. This external confidence strengthened the institutions, but also bound them to global currents they had never fully participated in. At the same time, subtle strains emerged. A few large borrowers struggled to meet their obligations. Trade routes experienced unexpected disruptions. Fluctuations in commodity prices created inconsistencies in accounts once known for their immaculate balance. Clerks, trained to detect irregularities, noticed shifts that did not fit historical patterns. Some raised concerns, but their warnings were tucked away beneath layers of optimism. Meanwhile, governments across the north, reliant on the trust houses to safeguard public funds and support infrastructure, encouraged continued expansion. Their endorsement added both legitimacy and pressure. It became harder for stewards to slow the pace without appearing resistant to national progress. By now, a quiet question lingered in the corridors: were the trust houses still built on discipline, or had they begun to drift into the same risks they once prided themselves on avoiding? No collapse had occurred. No scandal had surfaced. Yet those who observed the ledgers closely could feel a shift. Something fundamental had changed in the identity of the institutions. Growth was no longer an opportunity. It was becoming a test, one that would soon reveal whether the northern trust houses could evolve without compromising the very principles that had shaped their rise. The first serious strain struck during a season when the northern markets typically steadied themselves. A major shipping consortium, one long considered a pillar of regional trade, announced delays that rippled across ports from Bergen to Tallinn. Storms were blamed at first, but the ledgers revealed a different truth: the consortium had overextended itself, relying on credit lines from multiple trust houses to maintain an expansion that had outpaced demand. Payments that should have arrived weeks earlier failed to appear at all. Inside the trust houses, unease hardened into concern. Clerks reviewing the consortium's accounts saw patterns they recognized all too well: rolling obligations, overstated assets, and quiet withdrawals meant to mask liquidity shortages. These were the warning signs their institutions had once sworn to avoid. But now, they were entangled in them. Each trust house, believing itself safe, had unknowingly taken on exposure mirrored in the ledgers of its peers. What affected one now threatened all. Executives convened emergency meetings. Arguments erupted between stewards who insisted on immediate intervention and advisors who urged patience. Some feared that pressing the consortium too hard would trigger its collapse, sending shockwaves through a network built on interdependence. Others warned that delaying action would only deepen the damage. The debate revealed how far the trust houses had drifted from their disciplined origins. In the past, caution would have prevailed unequivocally. Now the path forward was clouded by ambition, partnerships, and obligations too tangled to unwind cleanly. Meanwhile, merchants reacted to growing uncertainty. Ship captains demanded payment guarantees before accepting cargo. Buyers negotiated aggressively, citing rumors of disrupted routes. Insurance brokers raised premiums, signaling their own assessment of rising risk. What had begun as a series of delays now felt like the first movement of a larger shift, one whose rhythm unsettled even seasoned traders. Foreign investors noticed as well. Subtle fluctuations in settlement times and interest spreads hinted at cracks forming beneath the region's famously stable financial surface. Reports circulated quietly through international circles: something was wrong in the north. Some investors began pulling capital, not dramatically, but steadily. Their exit left gaps that amplified liquidity strains at the trust houses already juggling unexpected losses. And then came the revelation that altered the crisis entirely. A detailed audit of the troubled consortium uncovered liabilities far exceeding earlier estimates. Not only had it borrowed heavily from multiple trust houses, but it had pledged the same assets to different lenders without disclosure. The discovery struck at the heart of the trust house's reputation. they had built their identity on rigorous verification. Yet in their pursuit of growth, they had overlooked the very discipline that had once set them apart. The news spread through the region with unsettling speed. Confidence, quiet, sturdy, taken for granted, began to tremble. Merchants whispered about overexposed portfolios. Advisors warned that more borrowers might be hiding similar imbalances. Governments, alerted to the audit, requested urgent briefings. The trust houses, once symbols of unshakable reliability, now faced a reckoning that threatened not only their stability but their identity. And as night settled over the northern ports, the leaders of these venerable institutions confronted a truth they had long tried to avoid: the system they built to withstand storms had slowly drifted into waters where storms formed faster than they could prepare. The question now was not whether trouble had arrived, it had. The question was whether the trust houses could prevent one borrower's collapse from dragging an entire financial culture down with it. The collapse unfolded with the quiet inevitability of winter icebreaking beneath too much weight. When the truth about the shipping consortium's hidden liabilities became public, confidence did not merely falter, it fractured. Merchants who had trusted the consortium for decades abruptly withheld new shipments. Foreign lenders suspended credit. Insurance firms refused coverage outright. The network that had once seemed so resilient now trembled with every passing hour. Inside the headquarters of the trust houses, the atmosphere turned grave. Each institution realized that the consortium's downfall exposed weaknesses far beyond a single borrower. Their ledgers revealed overlapping exposures, shared risks, and a troubling pattern: growth had come at the cost of verification. The trust houses had drifted toward the same vulnerabilities they once warned others against. Government ministers arrived within hours, summoned to emergency councils held behind sealed doors. Advisors presented stark projections: without swift intervention, multiple trust houses could face liquidity shortages within days. Allowing them to fail was unthinkable. They safeguarded public funds, retirement accounts, and payments critical to local economies. But rescuing them required decisive action that carried political cost. After tense debate, a plan emerged. The government would guarantee the trust houses' most essential obligations, inject emergency capital into the most exposed institutions, and temporarily oversee their restructuring. The announcement would be released before markets opened, aiming to stabilize sentiment before panic could take root. It was a solution rooted in pragmatism, not pride. When dawn arrived, the decision became public. Reactions across the North were immediate and emotional. Many citizens felt relief, grateful that their savings and livelihoods had been protected. Others felt betrayed, realizing that the institutions they believed were immune to reckless risk had drifted dangerously close to disaster. Merchants adjusted their plans. Investors recalibrated their expectations. The northern financial identity, once defined by quiet reliability, felt forever altered. In the following weeks, the consequences unfolded. Audits laid bare years of overlooked warnings and unchecked optimism. Executives resigned. New oversight mechanisms were introduced: strict limits on exposure, mandatory asset verification, and transparency reforms designed to restore a culture that valued discipline over growth. The trust houses survived, but they emerged humbled, reshaped by the crisis that had tested their foundations. Yet amid the uncertainty, something important remained. The crisis had not shattered the North's financial world. It had revealed its fragility, forced it to evolve, and reminded it of the principles that once made it strong. The region regained stability slowly, through steady reforms and a return to the values that built its early success: caution, clarity, and earned trust. In the end, the rise of the northern trust houses was not defined by their moment of weakness, but by what they learned from it. Their story endures as a reminder that even the most respected institutions must confront their own vulnerabilities, and that true stability comes not from avoiding risk, but from acknowledging it with honesty and resolve. Sometimes the smallest shift in perspective becomes the beginning of a new future.